rank all the different valuation methodologies, rank the 4 valuation methodologies from highest to lowest in terms of like the valuation that you would typically get.
You said the 4, correct? Just to confirm.
Yeah.
Okay, so before this, I just want to confirm the 4 you meant is DCF, trading comps, precedent transactions, and LBO, correct?
Yep.
Okay, so the highest one is precedent transactions. Second one, I would rank DCF. Third one, I would rank LBO. Fourth one, I would rank trading comparables.
Can you explain why?
Of course. So the first one, of course, the precedent transactions, because of the control premiums, like whatever valuation you get is, including those control premiums that the buyer paid for the seller to actually, get the control of the business. So in these transactions, you need to make and pay a premium for the control. So that's the reason. I ranked second one, the DCF, because it's based on the assumptions you make, and the DCF is used for strategic acquirers. So for that reason, I ranked it above the LBO, because most of the times, private equity companies will pay less than the strategic buyers. So that's why I ranked the DCF first, then the LBO, and the last one I ranked the trading comparables, because from what I know, and from it depends, it depends a lot, especially in the assumptions you make in the LBO and in the DCF, because it all depends who is doing the model, if it's the buy side or the sell side. So what I wanted to really get to the point is the trading comparables, it gives you the real-time valuation that the market is giving to the company. So that's why I ranked it the last. And yeah, those that's what my rationale behind that.
I don't think that's correct. So I think it's more nuanced. This is kind of a tricky question, right? So I would say like typically you would get a higher valuation on precedent transactions than you would on trading comps, because precedent transactions take into account the control premium, whereas like trading comps don't, right? And so you have to pay a higher price to get the seller to agree to the deal, right?
Okay.
In terms of the DCF, it's not that DCF is only used by strategics. That's not true. Anyone can use the DCF. DCF is just valuation methodology, but the DCF is not, I wouldn't put it at a certain, like, in a certain spot. I would say DCF is kind of a wild card. It can be anywhere. It could be as high or as low as you want it to be, because it just depends on what assumptions you're making, right? Like if you make really aggressive assumptions in your forecast, you're going to get to a much higher valuation.
Okay.
If you make very conservative assumptions, you're going to get to a lower valuation, right? Also, what are you assuming for the discount rate? Like that's going to affect the valuation. So like there's just a lot of different variables that you have to like make assumptions about. And typically what you see in a deal is that the seller's banker will make really aggressive assumptions because they want a higher price. And then the buyers make very conservative assumptions because they want to pay less. Right.
Got it.
So that's the DCF. And then on the LBO, we'll just say like, typically the LBO, this is nuanced also. It's kind of like, are we talking about like a closed LBO, or are we talking about just like, hey, we're doing an LBO model to see if the deal is even viable, right? If it's like, hey, this LBO actually closed, then it's kind of like a precedent transaction. Then presumably there's like a control premium baked in, and it'd probably be higher than your trading comps, right? But a lot of times, like if it's just like, hey, a private equity firm is doing an LBO analysis to see how much they'd be willing to pay for this deal, typically you're going to get a lower valuation, because we call it like the floor valuation, because the LBO model, what it's telling you is what is the highest price they can pay to buy this company to still hit the minimum IRR requirements, right? Because the higher the price they pay, the lower the IRR is going to be. So if they say like, hey, we're not going to do a deal that's less than 20% IRR, there is a ceiling to how much they can pay for the deal. Right?
Okay, got it.
Does that make sense?
Yeah, so you wouldn't give a fixed rank to LBO and DCF, just like to summarize.
Definitely would not for DCF, and then for LBO, you can just say, usually that's a floor, that's like the floor valuation, because there's a cap to how much a PE firm is usually willing to pay in order to still hit their hurdle rate. Right?
Okay.
But I just make the distinction, like, it depends on how you want to think about it when you say LBO. Like, if I'm looking at the LBOs, I'm like, this is an LBO that actually got done, you probably still have to pay a premium, right? Basically, the only LBOs that should be getting done are the ones that, even after paying the premium, still allow the PE firm to hit their IRR requirements.
Got it.
But like for every 20 LBOs that a PE firm looks at, they might do like one deal. Right? It means the other 19 LBOs that they did, the price that they got to was too low. It wasn't like a price that the seller would be interested at. Does that make sense?
No, totally. Totally.
Yeah, totally. Okay, so you got it right. Okay. Hey there, I hope you enjoyed this video. If you're looking for more customized advice that's tailored for your specific situation, then I invite you to book a free strategy session with our team at the link below. We'll talk to you soon.